Two houses, same street, same square footage, same list price. One of them sells. The other one falls out of escrow 3 days before closing. Not because of the inspection, not because of the price, because of a number no listing puts on the price tag. The insurance quote. According to the California Association of Realtors' own housing survey, about 7% of California deals fell apart in 2023 because the buyer couldn't get affordable insurance. 1 year later, it was over 13%. It nearly doubled in a single year. You've probably heard there's a California insurance crisis. That's the headline, and it's not wrong. But crisis is too broad a word for what this does to you as a buyer. Insurance used to be a footnote, a boring line in your closing costs you barely thought about. That's over. Insurance is now a second price tag on the house, invisible on the listing, able to swing your monthly cost by hundreds, and increasingly able to decide whether the deal closes at all. In the last video, the lesson was simple. The list price is not the price. This is the other half of that sentence. First, why crisis is too broad a frame. Then, how insurance reprices the house and kills deals. And then, what you actually do. Okay, let's go. Let's start with the headline version. After the Los Angeles fires in January 2025, insurers took historic losses. CalMatters reported those fires alone left insurers facing something like $40 billion in claims. Most of the top 12 home insurers in California paused, limited, or pulled back on new policies. Nearly 400,000 policies have been canceled or non-renewed since 2021, according to State Department of Insurance data. None of that is false. But here's what the headline skips. This is not hitting everyone equally. An analysis from the Center for Climate Integrity found the average State Farm policyholder would pay around $700 more in 2025 than in 2023. But in one Calabasas zip code, the average increase was almost $7,000, 68% in 2 years. Same company, same state, the exact same rate decision. And it lands completely differently depending on the zip code. $700 for one homeowner, $7,000 for another. That is not a crisis hitting everyone equally. That is a sorting machine. The question is not, is there a crisis? The question is, what does this specific address cost to insure? Because that number, not the list price, is what actually changed. 2 houses, both listed at $800,000. On Zillow, they look identical, but the monthly cost of a house is not just the mortgage. It is the mortgage, plus property taxes, plus insurance. For years, insurance was a rounding error. Now it is not. A standard policy that cost $1,500 a few years ago can run several thousand today. One Northern California agent told CNN about policies running $10,000 a year, and said for some buyers that is just impossible to absorb on top of closing costs. One house is lower risk. It's been hardened. Newer roof, real defensible space, nothing flammable hugging the walls. The other backs up to a brushy hillside. Same list price. But one can cost hundreds more per month, every month, just to insure. On paper, it is the same house. In your budget, it is a different house at a different price. Now here's the part that turns expensive into deal ending. Your lender requires insurance, no exceptions. You cannot close on a mortgage without an active policy. So insurance stops being only about cost. It becomes a gate. In fire-prone California, agents now describe the insurance contingency as one of the biggest reasons deals collapse. Inspection clears, price agreed, everyone ready to sign, and then the buyer cannot find a policy, or the only quote is so expensive they walk. The deal dies. That is the 13%. Buyers aren't getting cold feet here. The market is locking the door on them. And if you cannot find a policy on the regular market, you may end up on the FAIR plan, the state's insurer of last resort. Bare bones. Basically fire coverage. a $3 million cap as of this year, and many homeowners still need to bolt on a second top-up policy. Agents call it a difference in conditions wrap, just to get back to normal coverage. So you end up paying for 2 policies and still walking away with less protection than you started with. It is a tourniquet, not a solution. If you are buying, the single most important change is this: get an insurance quote before you remove your contingencies. Not after, before. Get a real quote on the actual address early, then put that monthly number next to the mortgage before you fall in love with the house. And do not assume the seller's premium is your premium. Their old policy may be locked in at a rate you will never see again. If you are selling, your home's insurability is now part of its value. A buyer who cannot insure your house may not be able to buy your house. And if that insurance number is ugly, fix what you can. That same advice applies to anyone who already owns. Under California's Safer from Wildfires rules, every admitted insurer now has to factor mitigation into your price. Class A roof, ember-resistant vents, real defensible space, clear space around the structure. These things can move the premium. Mitigation is no longer landscaping. It is part of the asset. One caveat: this is general information, not personal advice. Your situation is specific. Talk to a licensed agent before you make the call. So look, the California insurance crisis headline is not wrong. It is just pointing at the weather when the thing that actually hits you is the transaction. Insurance is not just a homeowner problem anymore. It is a deal problem. The number on the listing is not what decides whether the house closes. There is another number: the insurance. Find it out early, or it finds you at the worst possible moment. Because in California now, the deal is not real until the insurance is real. And if you are in California, drop your county or metro in the comments. What happened to your home insurance lately? Renewed fine? Non-renewed? Premium doubled? Pushed toward the fair plan? No addresses, no exact dollar amounts, just the local read. That is what tells me which markets to dig into next. And subscribe so you don't miss it when your market comes up.